With many of the Magnificent Seven stocks reporting earnings, we knew tech would be in big focus this week. And then Chinese startup DeepSeek sent shockwaves through the market. It upended our expectations of how much companies need to spend in that race for AI dominance. Interesting times. Joining us now to discuss is David Sekera, Chief U.S. Market Strategist with Morningstar Research. David, always great to have you on the program, particularly when we got big themes like this. Let's talk about, that was Monday, right? I wake up, I look at my phone, I'm like, what is going on and what is DeepSeek? Walk us through it.
I'm in the same boat as you where I went to sleep, Sunday night, haven't looked at the overnight futures market. Everything looked fine. And then wake up in the morning and, see just how much the markets were down. But yeah, I think it was really a very interesting market reaction, especially when you start digging into, what was going on with a lot of the individual stocks. And to be honest, I think this really illustrates the point that we made in our 2025 outlook that we think 2025 is really going to be the year of evolution in AI. So really, when you think about what's been going on, 2023, 2024 is all about the GPUs, the hardware, the platforms, and so forth. But I think 2025 is going to be the year the market really starts looking to identify those companies that can utilize AI in order to either drive revenue, and or expand their operating margins. So specifically, looking for those companies that can use AI to improve, their existing products and services, but also those that are going to be able to utilize AI to develop new and novel product and services. And that's what's going to give companies, the competitive edge going forward, what's going to allow them to capture new business, raise pricing, and defend against customer attrition. And of course, which companies can take AI, utilize that in their own business model, find out how they can enhance productivity, use that to drive margins. So when I look at the individual stock action on Monday, a lot of those companies that we consider to be the long-term beneficiaries of, better, cheaper, faster AI, all traded up. So companies like Meta, Amazon, ServiceNow all did well on Monday, whereas really those hardware companies, the GPU providers, the hardware providers, NVIDIA, Broadcom, Arista, Marvell, that all traded off.
So we get that taste of the evolution you were anticipating for this year when it comes to AI. Is there anything about what happened earlier this week that's making you change your assumptions about the space?
Not yet. Of course, we're going to keep a close eye on here, but our assumptions are still unchanged for now. We're certainly listening to hear, what comes out and what comes out next week, from guidance from, some of the larger players in the AI space. But for now, after talking to our technology team, there's still a lot that's very unknown, very uncertain as far as, what exactly, DeepSeek's capabilities and costs are. So I think still a lot to be learned, as far as exactly, what DeepSeek can and can't do. But for now, we still see in the short term, AI GPU, the demand still well exceeding the amount of supply out there. The hyperscalers are still building out data centers and cloud capabilities. So for now, we still expect that technology firms are going to just still be out there buying all the GPUs that they can as part of their AI build out.
Yeah, they don't appear to be in retreat just yet from some of the comments we've been getting from Meta and Microsoft this week. When I think about the stocks that have been the big beneficiaries in the sector from AI, of course, NVIDIA is the one we talk about the most, Microsoft, Tesla in the mix. Utilities, there were some interesting sort of fallout effects on Monday. Well, what are you thinking about some of those names?
So really just going to depend on which classification of stock you're looking at. And I kind of think about the AI names, here now breaking into two classifications. So, even after the pullback on Monday, a lot of those AI hardware stocks that were, overvalued in our mind, even after the pullback are still pretty fully valued, if not still overvalued. Whereas, those that we expect to be the beneficiaries of AI in often cases are still attractive. And it was interesting to see, some of those utility stocks, specifically the independent power producers, that last year were really considered a second derivative play on AI. Of course, AI technology requires multiple times more electricity to power than traditional computing. A lot of those stocks had just skyrocketed last year. So some of those we saw, well over 20, if not 30% declines. And according to our team, some of those were like some of the most overvalued stocks, according to our valuations, across our entire U.S. coverage.
All right, so that was the names. You said some secondary plays, the NVIDIA right at the heart of the AI action. What about the overall market? Because it was a pretty big pullback across the board. S&P 500 felt it. What are we thinking there in terms of a valuation basis?
Well, overall, when we take a composite of, all of those stocks that we cover, it's over 700 that trade on U.S. exchanges, and compare that to where they're trading. On a market cap weighted basis, the market is trading at a slight premium to our fair value. It's probably close to the upper end of the range that we still consider fair value, but I do see a lot of bifurcation going on in the marketplace. So if we look at like the growth category versus the value category, growth stocks, as a category are trading pretty much at the greatest valuation to their fair values that I've seen, since early 2021. And of course, that was when the disruptive technology bubble, hit its peak, whereas value stocks still at a slight discount to fair value. And then when we break it down by capitalization, large cap stocks trading, a bit above fair value. So that might be an area that you might want to, take a look at your portfolio, see if there's some opportunities to take profit there. But we still like small cap stocks, on a valuation basis. That's probably one of the more undervalued areas of the marketplace.
Now, when we take a look, of course, the returns of 2024, we know that if people were long the broader equity market, the returns were pretty good. What are we expecting for the first half of this year?
Well, with the market kind of at this, slight premium to our fair values, and when we look at the individual stocks, especially those stocks that drove the market higher last year, many of those are also fully valued, if not also overvalued. I think we're looking for, pretty flat market return, maybe some potential of, maybe a couple of sell-offs, here and there if there's some negative catalysts out there, but really not looking for much, price appreciation in the first half of the year. To some degree, I think we need to let earnings, catch up to where valuations are. In my view, that's probably not until the second half of this year. So until then, with market appreciation being, probably pretty minimal, I think market positioning is becoming ever more important today.
Okay, let's talk about that. If you're not going to get that big of a bump, actually, just from stocks moving higher, what about dividend payers?
Exactly. And that's been one area of the market that we do see a lot of attractive opportunities today. So I think it's a combination of not only can you find a lot of dividend stocks that we think are trading, below our long-term intrinsic valuation, but of course you can also kind of get, paid to wait, a lot of these stocks, 4 or 5, even 6%, type of dividend yields. So with the market at the top end of that fair value range, I think you're going to be better off in those high dividend paying stocks. And of course, I'd also recommend, taking a look for those that we rate with, a wide or a narrow economic moat. Those are the companies that we believe have, long-term durable competitive advantages. So if we do have, any kind of market correction or sell-off in the first half of the year, I'd suspect that those higher quality companies, especially those that pay pretty significant dividends, would perform better, to the downside.
Yeah, as you were saying there, and I've heard some other people and guests this year too, they wouldn't be surprised to see a pullback in the market off of these levels. What's the biggest risk to the market as it stands right now?
Well, in the short term, I still think it's got to be all about the potential for the Trump tariffs. And again, it's really going to be very idiosyncratic as far as, which countries is he going to put the tariffs out against? Is it going to be, the across the board that he's threatened? Is it going to be targeted to individual countries? And of course, even if it isn't across the board, are there going to be certain countries that maybe he got excluded, certain U.S. allies that maybe he doesn't include into those tariffs? And of course, then it also becomes, which individual products would he have exclusions for as well? So in my mind, I think kind of that wild card is probably the biggest, risk to the market, I think, here in the short term. In the medium term, I'm really more concerned about interest rates and inflation. So our U.S. economics team, does forecast that longer-term interest rates, specifically the 10-year U.S. Treasury, should decline over the course of this year, getting down to maybe 4.25%, and then to a 3 handle in 2026. And they also expect inflation to moderate, this year and into next. So if I did look and see, interest rates, start climbing back up, if the U.S. 10-year started getting close to that 5 handle, that would start to concern me as far as valuation and people maybe moving out of stocks and into fixed income. And inflation metrics have been pretty sticky. In fact, some of those inflation metrics have actually even ticked up a little bit over the past couple of months. So if we don't see inflation start to moderate, or worst case scenario, if inflation starts moving back up, I think that also could hit the markets.